Good afternoon, everyone. Welcome to Space42 full year 2025 earnings call. I'm Bruno Priuli, Head of Investor Relations and your host for today. Joining me are Karim Sabag, Managing Director, and Andrew Cole, CFO. Before we start, let me go through the usual housekeeping rules. All participants are currently in listen-only mode, and we will have a question and answer session at the end of the presentation. In the meantime, please feel free to post your questions in writing on the chat as we go through the slides. I'll then read them out during the Q&A session. You can also ask questions orally by using the raise your hand feature, and I will hand the floor over to you to announce yourself and ask questions. Please note that Safe Harbor applies, and a replay of today's webcast will be recorded and made available on our website. With that, Karim, over to you to start us off.
Thank you, Bruno, and welcome everyone. This conversation reflects completion of our first fiscal year of Space42. I would like to take this opportunity to remind everyone in relation to our thesis from the start in the formation of Space42, which was predicated on four hypotheses. The first one is the ability to grow our business and scale it globally. This was not just about strengthening our position as a national champion, but earning our rightful place as a global, successful, and differentiated operator. Secondly is, in doing so, to focus on our core capabilities in two domains, specifically satellite communication and geospatial analytics, with artificial intelligence at the core of the work that we do. Thirdly is to deliver and sustain operational synergies that we started achieving on day one, and we continue to track and set as an objective for the management. And last but not least, in the early innings of the merger, is to make sure that we are laser focused on retiring non-differentiated capabilities and practices so that we start with four core pillars that will allow us to achieve our objectives. And so on the page before you, I want to emphasize the four areas that defines our performance during the first year. First of all, the return to growth when it comes to our satellite communication business, which is largely stagnant globally. And nevertheless, as we have said from the very beginning, we have in our house differentiated capabilities that allow us to drive growth and drive operational efficiencies. So our business during Q4 of 2025 grew by 7%, but equally important, during the second half of the year, we grew by 14%, largely now with the benefit of Thuraya 4, one of the most formidable, if not the most formidable, mobile satellite services satellite ever deployed, which entered operation during the second half of this year. The second important area of focus during last year has been our zeroing on the strategy execution, specifically one, remain faithful to the four core pillars that we have set from day one so that we are not distracted, either from a capital deployment standpoint or from the standpoint of where we want management to spend its time. Secondly, recognizing the very ambitious program or targets ahead of us, making sure that we have a meeting of the mind with partners globally who can be part of our journey. And over the course of 2025, we firmed up partnerships with Viasat when it comes to Equitas, with Esri and Microsoft when it comes to our very ambitious project on Map Africa. And we continue to build on our partnership with ISI when it comes to deploying one of the most advanced systems for Earth observation globally. And so that approach, one of being very ambitious in terms of our global footprint, but also bringing on board like-minded partner, will remain core to our DNA. Now, recognizing that every merger entails a healthy dose of transformation, 2025 was also a year of a strategy-based transformation where, notwithstanding the importance of setting the four core pillars, equally important was to make sure that we're retiring non-differentiated capabilities and practices, which we have done. And the impairment or the adjustment that we've announced in our result is a reflection of that. I want to make sure that management now is starting with a strong foundation has addressed any legacy issues that for different reasons were not dealt with in the past. This is the management team that is responsible for them now, and our taking on this adjustment today is a demonstration of this responsibility. And last but not least, and I'll leave it to Andrew to expand on this, we're starting with a very strong financial fundamentals with our balance sheet, and Andrew will add more colors on this particular point later in our conversation today. Now, let me move to a reminder of our 4 core pillars. And this is our North Star day in, day out. These are the 4 things we will do, and everything else, the 4 gazillion other things that we could do, we will not do them. Under Smart Solution, our number 1 priority is to become the preferred partner for premium geospatial data, which effectively means, A, that we are deploying the most differentiated capabilities in space, so our own spacecraft with different type of sensors that addresses the use cases that are part of our remit, whether they are in defense and security or for commercial applications. And we're in the process of building a tier 1 sovereign multi-sensor Earth observation system, and we're well underway. In fact, Foresight 3, 4, and 5 will enter operation in Q2 2026, and this is where we will start seeing a buildup of revenue specifically for Smart Solution. This is something that has been in a build-up process, and I wanted to make sure that early on in our conversation today, I addressed the question as to when we will start seeing the investment in Smart Solution, the transformation paying dividend, and that's the time when we are sort of focused on it. Secondly is to continue to double down on our downstream capability when it comes to building our geospatial analytical platform, specifically GIQ and GIX. And 2025 was an important year in terms of now deploying the system beyond the confines of the UAE. Today, it is a global platform available on the Azure marketplace with a growing number of user base. And so these are the 2 thrusts that Smart Solution is focusing on. Moving on to space services, which was a vehicle of very significant growth during the course of 2025 and double-digit growth during the second half of 2025. The third pillar deals with the deployment of a global non-terrestrial network system, specifically the Equitas system. As a reminder, this is a joint venture that we are setting up with Viasat, and the idea is that we are setting up as founders with a view that we want to attract other like-minded satellite operators. For those of you who are either familiar with the space industry or are new to the space industry, what has prevented our domain to scale the way terrestrial technologies have scaled were probably 3 parameters over the past 50 years. 1, the scale of resources required, capital investment required to deploy systems that can have global coverage. So this was hurdle number 1. 2, common standards that could allow a single solution to deliver services across countries without any barriers to entries. I mean, barriers to entries that will require significant re-engineerings on the system. And thirdly, access to scarce resources, in this case, spectrum, that will facilitate the delivery of services in a seamless manner, in a way that is frictionless to the end user. They don't have to switch any button. They don't have to change terminals. The same unit can operate in country A and country B, in use case A or in use case B. And Equitas was created to address these 3 hurdles. So it's a shared effort where we can bring our capital and the capital of like-minded partner to deploy the most formidable system ever built for direct-to-device. 2, it is a system that once deployed overnight will be able to connect with billions of terminals, whether the terminal is an unmodified iPhone or an Android-based device, or the billions of IoT devices that follow industry standards. And equally important is the fact that we can do this with a globally harmonized spectrum, something that no other wannabe direct-to-device solution can replicate. And this is quite unique to what Equitas is pursuing. And as we deploy the system over the next, we produce, manufacture, and deploy the system over the next 3 years. Specifically, Space42 will be targeting a customer base covering 75 countries, which will allow us to serve no less than 2 billion end users in the form of mobile end users and an equal number of IoT devices. And to put a dollar number to this for the benefit of this audience, this is a total addressable market of $6 billion US. And as I said during the investor day, what we're doing with Equitas dwarfs anything that legacy ESA and Bayanat has done. But it should not be surprising because we're moving from being a national champion to become a global player with its rightful place as one of the leader, if not the leader, in direct-to-device services. So I wanted to make sure I take this opportunity to explain what we're doing with Equitas. Next week at the Mobile World Congress, ourselves and Viasat will be updating at the forum or the different stakeholders who are part of the Equitas ecosystem on the progress we've achieved today and the milestones ahead of us. And we remain on track to deploy the system over the next 3 years. Last but not least, core pillar number 4 pertains to the secure connectivity services that historically were the genesis of ESA, and we continue to build on this legacy with the Area 4, Area 5 programs that are progressing nominally. And in fact, the first one will be launched in 2027, and the next one will follow in 2028. And along the same vein, as already stated by my colleague and CEO of Space Services, Ali Hashmi, we are working on executing a strategy for a multi-orbit communication system, and I'll shed a bit more light on this later in our conversation. So again, we remain single-minded focused on these pillars. This is how we hold ourselves accountable within the management team, vis-a-vis the board, and this would be our communication platform with you today and in the future. Now, let me move to page number 9 directly to sort of add a bit more colors about what we're doing, what we have done so far in 2025 regarding 4 core pillars. So the Foresight system is in the process of being deployed. Foresight 1 and 2 were already deployed. We did not bring them into operation yet. The core of the operation will start with Foresight 3, 4, and 5. And in fact, Foresight 1 and 2 will be upgraded with the same initial investment, so not with a new investment, so that we benefit from the technology insertions that our partner ISI has brought. And this is a very important parameter in the space industry, and certainly in the playbook of Space42. Going forward, every asset we deploy, every asset class we deploy, has to have a very clear roadmap about how the technology that we're deploying, let's say, how do we improve the sensor or the antenna or the payload, and how every generation will be backward compatible. And how do we make sure that we don't lock ourselves for a very long period of time into a technology standard or a technology model that doesn't have a clear evolution roadmap. And so to the credit of the relation that exists between Space42 and ISI, we were able to achieve this technology insertion approach, which is being applied to the Foresight system. So as I've stated in my introduction, as of the second quarter of this year, we will start delivering services and generating revenue on the Foresight constellation. Map Africa is a very ambitious project. It's about developing base map and other mapping information for the entire African continent. So you just have to imagine that this is 30% of the world habitable land. So this is not an insignificant effort. And the fact that I'm insisting on it is a reflection of the reality that these base maps at the level of precision we intend to produce them with our partners Microsoft and Esri do not exist today. So this is, to be very clear, remains a commercial venture. So this is an activity as part of our remit, but we're also equally convinced that it will have a marked impact on the societies and the economies that we are serving today and be further serving with this capability. Last but not least, on this page, Mira Aerospace has made significant progress. In fact, late last year and early this year, they have completed a number of demonstrations, including Europe's first commercially licensed flight in Spain, which is quite of a premiere. And the benefit of this particular platform is that it can be brought to use within a matter of hours, and it can take any of a satcom payload or a sensor sensing payload, i.e. an Earth observation payload, and conduct missions for an extended period of time and then be brought back to whatever base is being used to operate this platform. Moving on to page number 10, the progress on GIQ GIX is progressing very well. As a reminder, this is a one-of-a-kind platform that allow us and our client, whether they are in defense and security or in the commercial arena, to acquire data, to manage it, to process it, and to translate this into intelligence that can be reported to the relevant stakeholders for informed decision making. And I think a number of you who attended our investor day had the benefit of a demonstration to this effect. And the plan going forward is to continue to invest in our GIQ platform. It is, in fact, one of the KPIs that management is accountable for vis-a-vis the board in terms of the pace of progression of the GIQ GIX platform. So this is not just a dormant software, one of our servers. It's one of the active capability that we're building that is highly differentiated and is already a source of significant revenues for Smart Solution. Moving on to pillar number 3, already expanded on the Thuraya 4 launch and bringing it into operation. And I would posit that we're still in the early innings of making full commercial use of this particular asset. It's quite unique both in terms of the use case it enables, not just because of the capabilities on the asset itself, i.e. the satellite in space, but because of the diligent work of the space services team in building the terminals on the ground that serves a number of use cases. And I think many of you have had the opportunity to either see the new products or actually to get a demonstration of the use cases that these products are serving. On the right-hand side, this is a reminder of what Equitas represents to us. It is super ambitious and in the not so distant future. So our runway is a 3-year runway. This will be a project that truly puts Space42 on a global map, and not just a matter of becoming a global leader in direct-to-device, but being able to fulfill our mission, which is truly to enlighten the world from space, really make a difference in terms of the societies and the economies we serve. Because you have to remember that our intent here is to be able to expand or extend the mobility experience in any type of geographies for the billions of users, whether they are in covered area and they happen to go into uncovered area, or they largely operate in uncovered areas on land, or in the third bucket, in uncovered areas in the air or at sea. And so this is a very ambitious project. It's well underway, and I invite you to stay tuned to the update we'll provide next week at the Mobile World Congress. Our work on page 12 on Thuraya 4 and 5 is progressing nominally, and therefore we remain on track for the launches in 2027 and 2028. In fact, these programs, the precursor of these programs are already generating revenues today with a book of business that has a very long-term commitment, as already stated in earlier communications, both by my colleagues, Andrew and Ali El-Hashim. Last but not least, I want to conclude on the next big project we're pursuing on page 13, which is to complement our secure communication capabilities with a non-geostationary system. We're in discussion with a global partner to implement a national solution building on a global network. And so the benefit of this approach is that we will have UAE stability building on a global system. It will have, for the first time, all the sovereign features that are required in today's environment, whether they are for commercial use or for defense and security. Because it's a partnership with a global partner, it entails a low capex deployment, and therefore it's all about sharpening our pens when it comes to designing, devising, and delivering and operating the services that we will be delivering with our partners. And with the ability also to provide the roaming capabilities, i.e. when we are connecting and bringing on board a customer in the UAE, and this customer happens to be in another country, they'll be able to afford this particular service with them. Again, this is a particular or an important features of what we're designing. So in a sense, and as I said in the beginning, it's about working with like-minded partner to be able to prosecute our 4 core pillars. And my concluding slide, when it comes to what we have done in 2025, specifically on the LEO system, is to sort of reaffirm our intent to deploy non-geostationary SATCOM capabilities over the course of 2026 and starting in 2027, and to be able to do this without committing our capital for this particular purpose, but in fact benefiting from the capital deployment of our partner, but putting on top of this the sovereign features that are quite unique to the work that we are doing today. And last but not least, I want to remind you that at the end, what will remain as a measure of us remaining on track with our strategy is, one, making sure that each one of our initiatives is delivering programmatic growth. 2, it's all about sustainable differentiation, and that there are at the core capabilities that we can own and we can evolve going forward. This is not about a one-off capability that will serve us for a year or 2, and then we'll have to go out and reinvent the wheel. It's about an evolution that we continue to move forward. Scalability matters. In fact, across all the initiatives that I've walked you through, every one of them has global scale. Even the LEO model that I've outlined to you is something that we intend to replicate in other markets once we firm up the platform here, given the, I think, privileged position that we as Space42 have, and by default through the very constructive relationship that the UAE government has with a number of other nations around the world. So this particular ability to go into new markets and be able now to offer and rewire this a similar package in other countries is something that is part of our roadmap. And last but not least, this will continue to be governed by our financial framework, which provides this stewardship that, in a sense, maintains this discipline of capital deployment within our management team and vis-a-vis the board as representing our shareholders. And on that note, over to you, Andrew.
Thank you, Karim, and good afternoon, good morning, everybody. Thank you for attending our call. I will take you through our financials. This first page here really gives you the high-level messages, and overall, I would characterize 2025 really as a resilient financial year off the back of very sound fundamentals. Now, it is true that the top-line revenues are down versus the prior year for the full year by 8%, which is reflecting the ongoing transition of the Smart Solutions business, as Karim outlined. But equally, it's true that we've had a very, very strong end to the year, Q4, of revenues up 7% year-on-year. In fact, our first quarter of year-on-year growth since the merger certainly turned the corner. And it's also true that the space services business, which accounts for almost 80% of the group's revenues, had a stellar performance. It grew its full-year revenues by 6%. As Karim mentioned, its H2 revenues were up 14%, and it recorded not only its second highest revenues on record, but its highest ever normalized EBITDA and net profit. From a cost perspective, there was strong degree of restraint and rigor across the cost base. We essentially have 3 buckets of costs. We have cost of revenue, staff costs, and other OPEX. And when you exclude one-off items, which we'll come on to in a moment, on a normalized basis, that cost base was completely flat year-on-year. Okay, so there was a lot of cost control there, which meant ultimately that the margins remained robust at just under 40% EBITDA margin. Now, underpinning all of that then is the balance sheet, the cash flows. The position there is extremely strong. We closed the year with $1 billion of cash, negative net debt of $700 million, negative leverage. This is off the back of normalized EBITDA of -3.2 times, kind of a historic low on that respect. And importantly, an improved operating cash flow year-on-year. And of course, not last but not least, the backlog of $6.5 billion of secure future revenue that's already signed. That is equivalent, to put it in context, more than 11 times our 2025 revenue. So when you put all these elements together, we enter 2026 in good shape. we enter 2026 clearly with momentum to the top line, with a high degree of cost restraint and significant capacity in our balance sheet and resources available to us to execute the growth strategy that Karim has just outlined. Now, the line-by-line overview of the P&Ls on the next page, I won't go through every line, I'll just pull out the key items. Obviously, the revenue at the top is down, as I said, 8%. That should just put it in context. At the end of Q3 for the 9 months, it was down 15%. So the strong Q4 has certainly recovered some of this position. As I say, we're entering now 2026 with momentum. Within that 53, you had growth in the space services business of 27 million, 6%, underpinned clearly by the new Thuraya 4 satellite, offset by a softer smart solutions down 80 million, reflecting not just the transition that's undergoing, but for the projects that we are executing on, there have been some unavoidable delays in the execution of some of those milestones, which is not always within our control. The cost base in the next 3 lines, cost of revenue, staff costs, and other OpEx. And as I said, on a normalized basis, excluding one-off items, these were flat year on year. You will see that the staff costs are completely flat and you strip out restructuring costs. The other OpEx, you see a big increase there. And all of that increase relates to a one-off impairment, and I emphasize the words one-off, a one-off impairment of legacy smart solutions, receivables, and contract assets, which at the end of the day reflects a more prudent assessment of their recoverability following the introduction of an age-based provision matrix that we introduced in 2025. And there's full disclosure of that in note 21 to our financial statements. The other income, year on year, it's not really comparable because the prior year had 2 major one-off credits. One was liquidated damages of $30 million, and the other was a profit on the sale of a non-core asset. So this was always going to be lower because of those 2 one-off credits in the prior year. So because of the the transition of smart solutions, which impacted the top line, the one-off impairment which impacted the other OpEx, and clearly the one-off credits from the prior year, which flattened the other income, it did mean that on a reported basis, the EBITDA was down. But on a normalized basis, as you will see shortly when we go to it, the normalized profits were lower than prior year, but essentially a lot lower. The reduction was a lot lower than on a reported basis. So let's move on to that page. The next page gives you the normalized results. Now, you might be wondering, what do we mean by normalized? What we're doing here is we're stripping out from both periods one-off items that could otherwise distort the underlying operating performance of the business. So you can see in the prior year, this gain on the sale of an asset, it's not something that we do every year. This was a property. The liquidated damages is, well, unfortunately, not something that we have every year because it's not always a good thing. And the impairment you see in the current year has been added back because, again, this is one-off in nature. So on a normalized basis, you see the margins have remained broadly intact, still quite robust, but the absolute numbers are down, reflecting the revenue shortfall of the smart solutions business. Now, the following page gives you the breakdown of the revenue. The space services business, as I said, makes up almost 80% of the revenues, and excellent performance. Its revenues are up 6%, as I said, versus prior. Its H2 revenues were up 14%, and its Q4 revenues were the highest on record. And the clear tailwind here is the brand new Thuraya 4 satellite that Karim outlined. This is operating well. It operates over an expanding coverage area, higher throughput. It's attached to that as a $700 million 15-year government contract, which kicked in from the beginning of the second half of 2025. And there's also 16 new products which have either been launched or in the process of being launched. And we certainly expect the space services business to continue to grow in 2026, reflecting 1 full year as opposed to 6 months of that new satellite. The smart solutions business, as I said, is in a period of transition. And when we say transition, we mean we're moving it from a series of quite ad hoc one-off projects to programmatic activities. And what we mean by that is developing assets and capabilities to deliver a recurring, sustainable, and predictable revenue profile. So the building and operating the Foresight constellation, 7 of those satellites will be fully operational in August 2027. That is one example of how we're going to do that. Same with the GIQ platform, which is now commercially available on the Microsoft Azure platform from Q4 2025 onwards. So overall, the message here is, although for 2025 the revenues are down, 2025 Q4 is clearly the turning point. The situation is improving. We're entering 2026 with a significant amount of upward momentum. We have a similar analysis on the following page on the EBITDA. Here, the EBITDA is down, reflecting that revenue shortfall in Smart Solutions, which I've already explained. But it should not detract, I think, from, again, the Space Services business. You'll see the normalized EBITDA for Space Services here, 281 million, is a record performance, up 9% year on year. The following page outlines our future contracted revenues. This is essentially future revenue that's contracted as of today. It's dominated by 3 or 4 major government projects. And what you see on this page, you can see the total on the far right-hand side, $6.5 billion, which is equivalent, as I said, to more than 11 times annual revenue. You can see the rollout of this backlog and what it means from a revenue perspective. So what we're saying is, of the $6.5 billion backlog, 485 of that will unwind as real revenue. This is secure in the bag, if you like, for 2026 and so on. Page 22, next slide, outlines our cash position. It's a very strong cash position. It's a little bit lower than the start of the year, but it's still, I thought by any stretch of the imagination, the balance sheet remains extremely strong. The operating cash flow, which is a very important metric, was stronger than the prior year. We had the benefit of a second advance payment pursuant to the $5.1 billion government contract of 300 million. We received that in October, I think, from memory. The cash flow from investing activities is essentially CapEx, which was dominated by investment in the ongoing Ariane 4, Ariane 5 program. Those 2 satellites scheduled for launch in 2027 and 2028, respectively, and attached to that is the $5.1 billion 17-year contract. And then we had quite a significant amount of debt repaid. At the start of the year, we repaid the short-term bridge for 250, and then we continued to pay down the term loan originally taken out in 2021, very little of that left now, as well as the ECA loans, as export credit finance loan backing the Thrive 4 satellite. The balance sheet on the next page, no serious surprises there. The big movers here are the capital work in progress. As the Thrive 4 satellite entered operations, it then moved from capital work in progress into fixed assets. The cash and short-term deposits I just touched on, that went down primarily because we repaid debt. You can see the borrowings was also similarly gone down significantly over the period. So that's essentially our financial performance. We have on the last page our financial framework, and we always like to bring it back to the financial framework because these are the pillars and principles on which we deploy capital: organic growth, inorganic growth, and returns maximization. And as I said in summary, it's been, mergers are challenging. I've never come across a merger that isn't challenging. The first year transition has been challenging, but there's no doubt that we've turned the corner, delivered a very, very strong Q4 performance, and have expectations of strong top-line revenue growth in 2026. Back to you, Bruno.
Thank you, Andrew. We will now begin the Q&A session of our call. Let's see if we have any raised hands. Hi, Amit. Please go ahead with your question.
Good afternoon again. So 2 main questions. One is with regards to the impairment. I appreciate the color provided by management, but just want to ascertain, was this related to the merger that took place, and what level of recovery could be expected going down the line? And what level of comfort, I guess, also management has that these are, in fact, written off completely. And the second is with regards to the dividend policy. We were, as shareholders, there was a commitment prior to the merger that there will be a sustainable, attractive, consistent dividend policy. And this is kind of clear on multiple documentations that were released. Is there any updates on that? I asked this question again, having raised this multiple times now, and despite the cash balance available and the retained earnings, it seems that there's no updates on that.
Okay, thank you, Ahmed. So insofar as the impairment's concerned, this doesn't sort of directly relate to the merger. what it reflects is the fact that we had on our books relating to the Smart Solutions business considerable number of receivables and contract assets which had aged a long period of time and which had not been recovered. So we have implemented an age-based provision matrix across these, which is quite normal across companies. And in so doing, we have made a provision. Now, that doesn't necessarily mean that these amounts can't be recovered. They've been provided against and have not been written off. And to the extent that we're successful in recovering any of these amounts in the future, which is perfectly possible, but obviously I can't make any commitment to that, then those provisions will be reversed. I should also add that we do not expect a repetition of this type of impairment again in the future. Insofar as dividends concerned, the board regularly and periodically reviews dividend. Okay, it normally does it once a year, once the financial results have been improved, and it has concluded not to pay dividends on this occasion. It doesn't necessarily mean it won't pay one in the future. It is true we have a significant cash balance on hand, but I don't know if you attended the investor day. We also have significant capex pipeline coming down the line in the execution of this growth strategy. For the programs that we have announced, we have a $1.7 billion capex envelope. That's for the ones that we have announced, and there are further to come shortly. We will communicate a policy in 2026 accordingly. Does that help answer your questions, Ahmed?
It does. I mean, if I'm allowed to maybe follow up with one, with regards to the capex spend, I fully understand and appreciate that. Is there any consideration given as to why a lot of the debt repayment is being prioritized at this stage, if that is the case, and is access to debt markets still available for the company?
It is available to us. Indeed, we have successfully secured during the year an export credit facility of $700 million, which today remains undrawn. It was heavily oversubscribed, I would say, across the syndicate of international banks. So the debt markets remain open to us. The repayment of the debt follows the amortization profile outlined in the underlying financing agreement. So I wouldn't say we're sort of consciously prioritizing it. We're just following what has already been planned.
Thank you. We have a question that came through the chat. Can you provide the revenue and EBITDA growth for 2026? Also, what will be the EBITDA margins?
What I think we could do is the following. Happy to add a bit more colors about some of the projects in terms of the magnitude of revenue delivery once they are fully deployed. And so I will take as an example, as on page 9, the Foresight system. Once the 7 satellites are deployed and fully in operation, the yearly revenue generated from the system, just from the first 7 satellites, will be equivalent to around $50 million per annum, which will represent a secure offtake by the UAE government. And so this fits the template of what myself and Andrew have emphasized time and again in terms of programmatic engagement as opposed to a one-off project. And this is a project, as you are familiar with, in the case of these spacecraft, they are deployed for a number of years. In this case, it will be 5 years, and then you will deploy the replacement constellation, and that's sort of the repetition, the scaling of the scale-up that goes forward. So this is one of the illustrations. Map Africa is another illustration of once up and running and it's delivering the actual services, i.e. the base map, would have a recurring revenue base anywhere between $40 and $50 million per annum. Again, because you have built a platform and there's a set of refresh that happens every year, because the reality is that the terrain continues to evolve and therefore there's a continuous refresh of these base maps. So I just provided you with 2 examples from our smart solution business. Now, this excludes other scale-up programs we're currently working on. And for those of you who attended our investor day last year and the year before, it covers level 1 initiatives, i.e. initiatives that have been approved and for which capital deployment has already been initiated. There are a handful of L2 initiatives, so initiatives which business case has already been concluded. The capital deployment hasn't been initiated yet that are of a larger scale, i.e. globally. And therefore, once we communicate these programs, I will certainly be in a position, myself and Andrew, to add a bit more colors about the recurring revenue that they will generate. Now, allow me to pivot to add a bit more colors on the equity system, because I think this is the one that will be more relevant to us. So on a yearly basis, the equity system, once deployed in the case of Space42 as a service provider. So this excludes any income we will receive through our participation in equities as a shared infrastructure, but through the relations we will have from the network operator, in this case, equities, and Space42 acquiring these space resource units, and then packaging and commercializing them. The top line from the delivery of these services, once the system is deployed during the course of this decade, would exceed the Satcom business we serve today, Space42. So I just want to give you an order of magnitude of what we're working on. So I guess you gentlemen, and if there are any ladies on the call, should appreciate that we're not interested in small projects that are going to deliver single-digit incremental growth in terms of millions of dollars. What matters to us is what capabilities can be developed, deploy, evolve, and scale globally. And I've just provided you a few illustrations of this. Does this help addressing the question that was raised? Okay.
Thank you, Karim. Let me open up to there's another question here. Alwini, would you like to ask your question?
Thank you for the call and for the presentation. Just maybe a follow-up on the revenue and the EBITDA guidance question. When should we expect the inflection year to show? I appreciate that there's a slide in terms of the backlog, etc., but that obviously doesn't capture the margins. So which year should we expect that there'll be a big inflection in terms of results? That's one. And then the second thing that as the company is more going to focus globally, scaling up, etc., could you please provide us an update in terms of the industry dynamics, the competitive landscape, new technologies that's coming out that may impact Space42's market position?
Sure. So I think the answer to your first question would be, is 2026, i.e. as part of the management plan, 2026 deliver significant growth both for our Satcom business as well as our geospatial business, specifically space services and smart solutions. So I think this also builds on what Andrew has covered, and we already have the programs in place to deliver these numbers. And to also be clear, particularly when it comes to smart solution, these programs were in build-up phase in 2025, and therefore it would have been unrealistic to expect them to sort of move the needle while we were retiring a number of legacy projects that are not part of the capability system that we are pursuing today. From an industry dynamic, this could be a long conversation. I think the way we want to think about it, and I invite you to sort of consider the following approach. The question that we always ask ourselves is, can the work that we're doing today continue to be differentiated in the future? And why can it continue to be differentiated? Whether it's because we have access to a scarce resource, so spectrum is an example of that, or because we have access to a technology with a roadmap for the evolution of this technology and a clear line of sight as to how this technology will continue to improve also from an efficiency standpoint, i.e. delivering the unit of service at a lower cost as we scale, because this matters. We're not interested in delivering services in space that continue to be restricted to a very small target or addressable target market. In our Satcom business, what differentiates us is on the secure communication part is the unique part of assets we have and our access, which is an unchallenged access to the spectrum that is our right legally and from a regulatory standpoint, and the fact that it is a sovereign capability that is trusted by the UAE government. And as many of you may appreciate, our industry has always had a dual use calling. And there is increasing emphasis on defense and security, not just in the case of Space42, but I think in the case of many industries that can serve defense and security, notwithstanding some of the capabilities that are deployed in the civilian arena. So the quality of the assets, the relationship we have, and our unique sort of rights to spectrum gives us the confidence that we continue to benefit from a sort of a privileged position that will deliver on our growth trajectory. Having said that, we still need to think about what comes next, and therefore our thought process in SATCOM in amplifying our infrastructure with a non-geostationary system that can still meet our requirements in the UAE and requirements that can replicate because of our relation with the Global South, Space42 and the UAE is something that we're working on. It's a project that has been in the making for the past 2 years. There is no precedent for it in the same way that there was no precedent for an Equitas-like concept. So it's a novel concept, and I expect us to be able to make the announcement in relation to this particular platform during the course of H1 2026. And it's a program that will therefore enter operation and start delivering revenues incremental to what we're doing in 2027. I don't want to put a number today on it. The day we will announce it, we will then share with you what is the equivalent target revenue that we'll be prosecuting. So I just gave you some colors when it comes to how do you think about industry dynamics impacting our business. I don't want to sort of enter into a general conversation. In the case of Earth observation, there are two, I think, distinct domains. One, the ability to access, acquire, aggregate, analyze, and interpret data. And so many of these capabilities are sovereign capabilities. And in the case of the UAE, Space42 is the champion. At the same time, the position of being able to sort of federate these functionalities together under a single platform is quite unique. I will posit that there are probably 2 or 3 comparable platforms globally. And so I think the early, not first mover, but the early mover advantage that we have, I think will serve us well when it comes to GIQ, GIX. And there's a commitment that we will continue to invest in that vein, which is why I took the liberty of explaining to all of you today that it's part of the management KPIs. Continue to evolve the GIQ, GIX platform, because that's a software-based platform with AI capability. We're first out of the starting gate with SASE capabilities, and certainly management should not sleep on its laurels when it comes to this, notwithstanding all the formal and informal recognitions we have received. I think the part that will get a lot of our efforts during the course of 2026, going back to industry dynamics, and in this case, affecting our geospatial business, particularly deploying sovereign assets in space. There is a follow-on project to Foresight we're currently working on. I'm not at liberty to sharing it today. It's part of the L2, so a program that has already been translated into a business case, has already been presented to the board of directors, that has a truly global scale. What will differentiate this program versus what we have started doing with Foresight is A, the scale of it, B, the fact that it will be a multi-sensor program. Many of the Earth observation service providers today tend to be focused on one type of sensor. So optical is the case in point, or infrared is another case in point, or synthetic aperture radio, so radar-based, which is an important service offering. The ability to put multiple sensor types under one roof to serve use cases that requires different type of intelligence or complementary type of intelligence would be quite unique. But at the same time, I want to emphasize you have to be able to do it, A, at a scale that lowers the space resource unit that you're producing in space, one, and B, that you have a partner that gives you a seat at the table when it comes to the technology evolution, so that you can benefit from the insertions of upgraded technology as they come to the market, and therefore you don't end up in a situation where your system becomes obsolete on a very short runway. And so we're very mindful of it. So we're taking the time required to sort of design this. And so that, I think, is a is a good description of the dynamics that we're managing day in, day out to make sure that we continue to comply with the tenets of our strategy, which is about differentiation, capability base, and scaling, and making sure that we're prudent about where do we deploy our capital and where we rely on the deployment of capital of other partners. Does this help?
Yeah, yes, thank you very much. Just a quick follow-up. Within the UAE, there's no company, there's still no company that does what Space42 does, right?
The short answer is no. No. So the short answer is no. And I think this is the privileged position that we started from at the start. But I want to also be very candid with you. And I will tell you, I'll use the same set of words that I use with my colleagues. We should not take this as an entitlement. This is a privilege that we have on which we need to build. And so you've heard me say a number of times that the UAE give us the foundation, gives us the sandbox to ideate, to trial, to learn, that once we get there and to start delivering, that once we get there, we need to become absolutely obsessed about the idea of how do you evolve this capability and how do you scale it globally, which, by the way, is the message that our leadership always conveys to us, starting with the board and the leadership of the country. So the short answer to your question or to your hypothesis is I agree, but we should not take this as an entitlement. We should take this as a privilege.
Any final questions? Thank you all for your time, interest, and thoughtful questions. Please don't hesitate to reach out to Investor Relations. We look forward to connecting again soon. Have a great rest of your day. Thank you.